All right, let's talk about one of the most important and honestly one of the scariest stories in modern economics, Japan's so-called lost decades. This isn't just some old history lesson. Nope, this is a 30-year masterclass on how markets, debt, and demographics can collide, and it's got some massive insights for every single one of us investing today.
We're all told the same thing, right? Invest for the long haul, diversify, be patient, and it'll all pay off. But what if that's not always true? What if you could follow all the rules, invest your money for decades, and still end up with less than you started with? It's a terrifying thought.
And this really gets to the heart of it. What do you do when the cold, hard data shows that the classic buy-and-hold strategy just fails? For an entire generation of Japanese investors, this wasn't some academic what-if. It was their reality for 30 years. Their story is a huge warning sign, and we need to understand exactly why it happened.
So here's how we're going to break this down. First, we'll look at the 30-year winter itself, what it actually felt like. Then we'll play detective and dissect the massive bubble that caused it all. After that, we'll get into the twin traps of debt and demographics, peek under the hood at Japan's unique corporate culture, and finally, pull out the essential lessons that you and I can use today.
Okay, let's dive right in. Let's start with the evidence. Just how bad was this so-called economic winter? What does it actually look like when one of the world's most powerful economies gets stuck in the ice for decades?
Our main piece of evidence is the Nikkei 225 index. Now, you can just think of this as Japan's S&P 500. It's a who's who of Japanese corporate titans. We're talking global powerhouses that you know and love, like Toyota, Sony, and Nintendo. These are the best of the best. This is our benchmark for the whole story.
Now get ready for this, because this is the number that just floors me every time I see it. Over a 27-year period, the total return of the Nikkei 225 was a negative 14%. Just let that sink in for a second. You could have put your money into the top companies of the third largest economy on Earth, waited for nearly 3 decades, and you would have lost money. That's just staggering.
And let's be super clear here, this was not about picking the wrong stocks. You could have owned the bluest of blue-chip companies. The problem wasn't the individual players on the field. The entire stadium was crumbling around them. It was a total system failure.
So to really get why this happened, we've got to jump in our time machine. We need to go back to the 1980s to witness one of the most spectacular and frankly insane economic booms in history, because that's what set the stage for the collapse.
It all started with a 4-step recipe for a bubble that might sound a little familiar. Step 1, the central bank slashed interest rates, making money super cheap. Step 2, with cheap money, loans became ridiculously easy to get. So what's step 3? Well, people took that easy money and piled into real estate, causing demand to just explode. And step 4? Boom! You've created one of the biggest real estate bubbles the world has ever seen.
And you can just see the frenzy on this timeline. The Nikkei stock market goes from around 10,000 to an unbelievable peak of almost 40,000 in just a few years. That's a 4x return. At the same time, real estate prices were so high, it was said that the land under the Imperial Palace in Tokyo was worth more than all of California. The feeling was that Japan was unstoppable.
So what was the tiny little pen that was about to pop this gigantic bubble? Well, it was a financial gadget called the adjustable rate mortgage, or an ARM. It's a very clever trap, really. It lures you in with a super low teaser interest rate for the first few years, but hiding in the fine print is a trigger that resets that rate to something much, much higher down the road.
And that reset was the beginning of the end. Once those teaser rates from the mid-80s started to expire, millions of homeowners suddenly faced mortgage payments they simply couldn't afford. It sparked a panic. You had a flood of sellers trying to get out, but nobody was buying. The whole thing came crashing down.
But here's the real mystery. The bubble burst, sure, but why didn't Japan just bounce back? Other countries have bubbles and they recover. The answer lies in 2 deep-seated problems that created a trap Japan couldn't escape: a mountain of debt and a demographic cliff. First, let's talk debt. Japan is, without a doubt, the global poster child for government debt. Look at this. Their national debt is 234% of their entire GDP. To put that in perspective, it's like saying your personal debts are more than double your entire annual salary. When you owe that much, you can't just work harder to get out of the hole. So, the government couldn't just spend its way out. What did they do? They turned to their central bank, which used a tool we all became very familiar with after 2008, quantitative easing, or QE. You can think of it like an economic defibrillator. The central bank pumps huge amounts of money directly into the financial system, trying to shock it back to life.
And this, right here, is where the story gets really wild. Japan didn't just try QE once, or 5 times, or even 10 times. They tried it 27 different times. 27! And after all of that, they still couldn't get the economy moving or generate the healthy inflation they were looking for. It was a stunning display of the limits of a central bank's power.
So you see, Japan was fighting a war on 2 fronts. On one side, this absolutely crushing pile of debt, and on the other, a demographic nightmare. Their population was aging rapidly, and their strict anti-immigration policies meant they had a shrinking workforce. It's really hard to grow your economy when you have fewer people working every year. It was the perfect storm.
So the economic hardware was clearly busted. But there's another layer to this. We have to look at the cultural software, the unique way Japanese corporations think and operate, to understand why their response to the crisis was so different.
See, there are basically 2 competing models of capitalism. In the US and the West, we have what's called the Anglo-American model. Its primary goal, above everything else, is to make money for the shareholders. But the traditional Japanese model is different. It's a stakeholder model. It believes the company has a responsibility not just to its shareholders, but also to its workers, its managers, its suppliers, and even the local community.
And that philosophy has real-world consequences. If your top priority is stability for everyone involved, you're going to be really hesitant to do things like mass layoffs or sell off unprofitable divisions, the kind of painful short-term moves that a Western company might make in a crisis. This cultural focus on stability made it very difficult for them to adapt quickly.
Okay, this brings us to the big payoff, the whole point of digging through this history. Japan's story is packed with powerful, absolutely critical lessons for anyone who has a single dollar invested in the market today.
Lesson number 1 is maybe the most humbling. You can be the best stock picker in the world. You can own a portfolio of amazing, world-class companies like Toyota and Sony. But if the entire system they're operating in is sinking, it doesn't matter. Systemic risk can and will swamp even the best-run ships.
Lesson number 2. Central banks are incredibly powerful, for sure, but they are not infallible. They're not wizards who can solve any problem by waving a money-printing wand. The fact that 27 rounds of QE couldn't fix Japan's deep-rooted problems is all the proof you need that monetary policy has very real limits.
And that leads us to the final and maybe most profound lesson. In the long run, economics comes down to people. A country's age, its birth rate, its workforce, these things are incredibly powerful forces. You can't fight them with interest rates alone. In many ways, demographics are destiny.
So in the end, Japan's experience isn't just a fascinating story. It's a bright, flashing warning light that's been on for 30 years. A warning about what happens when massive debt, a demographic decline, and a busted bubble all hit at once. And as we look around the world today, at other countries with high debt and aging populations, the real question is, are we listening to that warning?